In this session, I'm going to talk about the op risk data and the governance of that operations risk data. So, what are the different kinds of data that needs to be collected, and how is the governance part of that is associated? So, as an agenda, we will primarily look at what are the different event risk categories under the operations risk. So there are 7 different categories coming under the operations risk as per Basel II. So we'll try to understand all that 7 categories, including the examples of each of the category. Then we will look at collecting and reporting internal operations loss data. Internal data, what are the different hurdles in collecting the same? What are the different constraints that go into the collection of that data? So we'll look at internal operation loss data. Then what is the role that is played by risk control self-assessment? What does it mean and what role does it have as a part of the operations risk? What is the role of key risk indicators? Then business environment and control factors used in the few environments. We are looking at some of the examples of them. We look at the scenario analysis, what is the role that it plays in operations risk. Then we move towards understanding how is the operation risk profile different in different financial sectors. What happens in a retail banking? How is it different from a corporate banking? So we'll try to understand the operation risk profiles in different kinds of financial sectors and the risk management framework. So what are the different kinds of designs? If I want to design an operation risk framework, what are the common organizational designs that are currently available? So these are the things we are looking at in our session today. So moving towards the first agenda item, the different risk categories as per Basel II. There are 7 categories. So one category of operations risk is related to execution of the projects, delivery and process management. So there could be risks associated with task execution, delivering of the tasks and the process management. So these are the ones that are very frequent in nature. So all the kinds of human errors in the delivery process, in the execution, miscommunications, all these come under the execution, delivery and process management. So again, under the broad category of this, we see some subcategories. So with respect to transaction capturing, there could be a few errors. It could be human errors. It could be a majorly human errors. So the transaction capturing, execution of the transaction and maintenance of the transaction. So there could be data entry issues as an example. So wrong communication between the parties, the maintenance, loading error, lot of things relating to the transactions. Capturing of a transaction, execution of a transaction and the maintenance. Similarly, there could be risks associated with monitoring and reporting. So something I have to report on a regular basis, a monthly report, a daily report, somehow I fail to report that. That's a risk. Similarly, I have given an external report but somehow omitted some items as a part of the report. So whatever I am delivering to my customer, it is inaccurate. So that is one more risk that we are categorizing in the same category. Then the other broad category comes into the customer intake and documentation. So without taking the permission of the client, I worked on some of the data associated with the client. I did not give any kind of a disclaimer while giving a solution to the client. All the legal documents, whichever needs to be associated, they were missing. Similarly, I can have the same operation risk category associated with the account management of the customer. Right? I did not approve the access. So to the accounts, the access is typically not approved, but they are able to access some of the details. And there could be a non-client counterparty misperformance. So it could be vendors, it could be any other third parties, not necessarily the client, but all others, anyone, there could be a misperformance. Even that we are classifying under the execution and the delivery. And with respect to outsourcing, there could be issues. With respect to vendor, there could be disputes. All these things come under this one single operation risk category called as the execution, delivery, and process management. That's the reason the losses in this category are very much frequent in nature. Then the second broad category out of the 7 is the kind of risks associated with the clients, the products that we are developing, and even the business practices. So there could be a fiduciary breach or a guidelines violation wherein it is more associated with suitability of a client for a particular product without assessing whether the client is suitable for this particular fund. I am giving a investment advisory for that client. I have not disclosed all the fund details to the client. So all these things come under the suitability, disclosure, and fiduciary related risk. Even the market practices are improper. Antitrust, improper trade practices, collusions, illegal practices, manipulation of the market, insider trading, all these come under the client's products and business practices header. Then a flaw in the product, the defective products, the error in the model, even these get classified under the operations risk here. Then we are talking of selection, sponsorship, and exposure related errors, wherein I am failing to investigate the client as per the guideline. And even the advisory activities, there could be issues, especially the advisory services that I am providing to the client. The client may not be satisfied with those. Even those are the kind of operation risk categories. So two broad categories of operation risk we have looked at here. Something to do with the execution, delivery, and the process management. Then we have looked at the risks that are specific to clients, products, and business practices. Then we have the third category talking of business disruption and system failure, system related problem. Hardware, software, telecom, utility, disruptions, all these things come under this category. Then we have the next two categories talking of external and internal fraud, where theft of information, robbery of information, robbery of physical assets, forgery, check kiting, all these come under the theft aspect. Then even the system security, someone can hack the system. There is other kinds of damages that are involved in terms of stealing information from the system. All these come under the external fraud. The same things can go internally also. The theft, again internally, the employee can steal the information. He can do a credit fraud. He can create worthless deposits. The assets of the company can be misutilized for personal purposes. Misappropriation of the assets. Even the company's property can be maliciously damaged. Forgery. All these things come under the internal fraud category. And the other broader aspect in the internal fraud category is unauthorized activity. Transactions are not reported. A transaction is performed but is not reported in the system. We have seen a lot of scandals across the world happened because of this kind of a fraud. The type of a transaction is unauthorized. A person is not authorized for executing X type of transaction, but he has authorized that. He has executed that. The positions are wrongly marked. All these come under the internal fraud category. Then the sixth broad category is associated with the employment practices, especially the HR practices, the workplace safety, the relations of the employee relating to the compensation, salary, pay package, the benefit, termination, all these kind of things. Then how safe is the workplace employment? Is the workers' compensation in place? Healthy and safety rules associated with the employees? And is there any kind of discrimination against any kind of employees in terms of caste, creed, race, religion, gender, etc.? And the last of the seven broad categories defined by Basel for operations risk is the damage to the physical assets, where it could be because of disasters, natural disasters, or any man incurred kind of disasters. So it could be human losses, external sources like terrorism, vandalism, etc. So all these seven kind of categories are what are highlighted by Basel II as a part of the operations risk categories. Now, now that we know that these are the seven broad categories under which Basel has categorized the entire operation risk, now it's a big onus for the companies to collect this data. Now, what is the major source of the data? So what we typically talk of is one being the internal loss data, then we talk about external loss data, then we bring in scenario analysis and the business environment. So the major obviously is the internal loss data, where the company's own data. Of course, everything has its own advantages and disadvantages. We are not getting into that aspect. But obviously, the major chunk of the data should be the internal loss data itself. So that is where we are trying to look at what is that we do as a part of the collection of the internal operations loss data, what are the key challenges, and what are the key points to remember when we are collecting and reporting the internal loss data. Some of the important points: there is a severe challenge in terms of collecting huge volume of data. That too, we have the data in different formats, in different departments, different locations. Bringing all of them into a central repository is going to be a painful task. It involves huge costs, resources are heavily involved in making this happen. So what the companies typically do is they put something called a collection threshold. They say any loss that is greater than or equal to some X amount will be collected and shown in the repository. So any loss amounts which are smaller than this threshold will be simply ignored. In some cases it is fine, but if there are lot of transactions where there is a possibility of minimum loss, so frequency is much higher, high frequency, low severity kind of events, they do not get captured because of this threshold. And if they are more in number, they can really have a significant impact in establishing the risk profile of the business unit. Right? So if I keep disregarding small losses, the whole risk profile of the business unit can get badly affected. So we have to be very much thoughtful about setting a threshold for the collection of the data. In some cases, the entire risk profile gets completely different because of just omitting high frequency, low severity kind of loss events. And the other important point to create this kind of a repository is how much complete our database is. Many a times what happens is the employees who are really responsible for collecting all this loss data, somehow because of some reason, accidental or because of a fraud, they miss out sending this to the database. Right? Some kind of system problem could be there. When integrating it with a central database, even there could be a system problem in terms of updating the central repository. So we need to really ensure what kind of processes we have in place, what kind of measures we have in place to ensure that the database is complete, all the transactions, all the information that needs to go into the repository is going as per the mechanism. So we need to have different kinds of filters in place that capture the various operational issues and the operational loss information. If at all some information has not gone into the repository, there should be some mechanism to flag. If there is a duplicate information going, there should be a mechanism to handle that, and the entire process need to be investigated. So the objective is whatever is the internal loss data that we are collecting, there should be completeness associated with that data. Then how do we understand recoveries? Okay, today there is a loss because of some reason, but tomorrow there was a recovery of that, or probably after 3 months or 6 months there was some amount that was recovered. Now will I show the gross as a part of my loss, or will I show the net? That is what we have to understand, what needs to be shown. As per Basel 2, it does not allow the use of the recovery while you are talking of capital calculation. So the loss should be based on the gross itself, not on the net. Any recovery that is coming, it is not considered in the operation capital calculation for the risk purposes. So we are looking at only the gross losses, with the only exception only in case where we are talking of rapidly recovered losses. A loss occurred today, immediately there was a recovery. In that case, I may still think of going ahead with the net, right, rather than going ahead with the gross itself. When the recovery is much faster, then again, what is the definition of faster? Again, it has to be a subjective thing. But when the recovery is full amount, means by mistake I have transferred the money to some account, but immediately the money came back from that account to my account back. So it has happened quite quickly and the recovery is in full. Those kind of events we are calling as near misses, and near misses generally we are not considering as a part of the capital calculation for operations risk. So we have to have a very clear plan and policy in place regarding what we consider as recoveries and near misses. Then the collection of the information should even include what is the time period for resolution. Right? Probably there is a loss that has occurred, but I don't know what is the amount of loss until probably a court settlement occurs, which may take 5 to 10 years. So I don't even know how much is the loss amount. A loss has occurred, but the actual amount of loss will know only after a court settlement starts. And that may take 5 years or 10 years. So what is the time period I am considering? What is that? What is the amount for that associated risk event I have to consider as a part of my internal loss database? especially when there is a large time gap between the start of the event and the final closure, where I'll come to know the actual amount of loss. Because the case is very much complex, I may not get a solution to it immediately. In that case, I should have a very clear procedure how to handle those kind of long duration losses. At what point in time I will typically collate that loss into my loss database. So that's one more thing that needs to be focused on. Whether different kinds of costs that are incurred, what kind of different costs could be incurred associated with the loss, and can I add them to my loss? When you are talking of operations loss, all the expenses that are associated with the loss event, typically we will capture. But we will not capture the opportunity costs. Because I lost something, right? Because there was a fire in my factory, I lost job for 3 months. I'll not calculate the 3 months salary which I have lost. That's an opportunity cost for me. Any kind of a foregone revenue, because my factory is not operational, I have missed out something on the revenue. So those are insurance related losses. So they are not typically considered as losses into the operational loss data. If I have insurance, even the insurance recovery for that is not typically being considered as a part of the operational loss data. So whatever the cost that we have with respect to risk management, I might have taken an insurance policy. The premium that I am paying towards the insurance, or even the settlement that is coming from the insurance, none of these things are going into the operational loss data. Any kind of an enhancement that we have implemented to prevent future operational losses, some kind of risk control mechanisms that have been implemented, none of them, the costs associated with none of them go into the operational loss database. Then, regarding the provisioning of the expected operational losses, whatever the losses that are going to occur in the future. So regarding the future operating losses, we are not documenting them in the loss database. Only the past which have actually occurred, we are documenting that. So if there is an onerous contract, then the provisioning should be done for that. And even if there are restructuring costs, especially when there is a detailed formal plan for restructuring, then I can really consider a provision for the restructuring costs as well. So this is how we really need to collect the internal operating loss data. That's a huge exercise. There has to be a proper understanding and culture across the organization in terms of collecting and reporting the internal operational loss data. Now, once the data is there, now we are talking about how can I use the business environment related factors in terms of coming out with my loss data. So some of the important aspects in that regard are the risk control self-assessment and the key risk indicators. In the RCSA model, what we do is every firm, it will pick up a few experts and it will ask them. So especially each business process, what is their view on the status? Within the company, each business unit, they typically find out from them what is the status of each business process and sub-process. This is generally collected on a 12 to 18 months basis. Based on that, it does a color coding, red, amber, green. Some processes are in red, some of them are in green, and some of them are not up to the mark, which is in amber. Right? So based on the assessment given by the various experts on the different business units, this kind of a color coding goes. In some kind of companies, apart from the color coding, even there will be a quantification of all the risks. So there could be a kind of a scorecard approach or some kind of a subjective approach to do that scorecarding. Now this is where all the risks that are embedded in the firm's processes, they are properly documented. All the risks that are associated with the firm's processes, they are documented and a clear assessment of them is done. And the various drivers of risk are derived and what controls are associated with each of the risks. How do each of these risks be mitigated? That would be taken care of. And then the task starts where the managers have to identify and assess all the inherent risks, but they are not making any kind of inferences regarding the various controls that have been put. So they are generating different kinds of risk scenarios. In the risk scenarios, what they need to focus on are, so in each of the business process, what are the potential chances of failure? What do we mean by failure in each of the processes? Where can the process fail? So we have to identify different kinds of risk scenarios. Every manager has to identify different risk scenarios as a part of his or her process. And then along with the scenario, they have to even identify what is the exposure. How big a loss can happen? If at all there is a failure, what is the size of the loss? How big? What is the severity associated with that particular failure? And if one failure occurs in one of the processes, what is the level of contagion effect that is there with respect to the other processes? How much is this particular process linked with the other processes? What is the correlation between this process and the other processes? Because if it is highly correlated, then probably it could be a full failure across a series of processes which can affect a business unit performance altogether and which can really play an important role in the organization's performance as well. So RCSA forms a very important aspect in terms of understanding the risk of the business unit and at the same time taking appropriate control to check what preventive measures could typically be taken. Then the other aspect we are looking at which plays an important role is identification of the key risk indicators. Generally they are quantitative in nature. So we are looking at the quality of the control environment of the business, how good it is. How do I make sure that the quality assurance department of my organization is performing well? What are the measures to I say that the quality control is happening appropriately in my organization? So this data should be very much reliable. Only then I can understand the relationship between the various measures and the losses. So if I have to really establish a correlation between the various indicators and the losses my organization is indicating, I need to collect the data which is more and more reliable. Right? And in general, if the causal relationship is at a very granular level, I can really identify the data that can fit to the model. And we should also look at external factors that are impacting the losses, looking at how the equity market indices are really playing a role in the losses, how the interest rates are impacting the losses. All these different kinds of external factors also need to be looked at and key risk indicators need to be set accordingly. Now, if I am looking at the different business environment related control factors, so if you look at the system, What are the various factors that could impact my system? There could be a downtime. There could be a slow time. My system would be slow for some part of the time. The software which I am which I have installed could be very much unstable. So for each thing, again, I have a KRI, key risk indicator. For a system downtime, I say number of minutes. The system is offline. For software stability, I can talk about number of code lines changed in a program. So these all could be the various factors that I can look at, which are set as key risk indicators. Look at the people. So people related, if I'm looking at the various factors, probably employees. How many employees are there? What is the experience of the employees? If I'm looking at execution, how many transactions are processed? Out of them, how many of them fail? What is the ratio of the transactions with errors? So this divided by this. And how many breaks are there in the transaction? All these are the different values that I am collecting. I'll compare them against the key risk indicators, and this is where I talk about the efficiency of the process that efficiency of the risk management process in the organization. Then one more way of collecting the data, operation risk data, is through scenario analysis. Especially if I don't have the internal loss data or external loss data associated with a special kind of a transactions for specific kind of a operational risk event, if I don't have either the internal or the operation or the external loss data, probably scenario analysis is one of the more important aspects to look at. Generally, this data is collected through the expert opinions. So all these experts, they have to give their estimates on how in a particular situation a losses can occur. When some extreme event occurs, when let's say a run on the bank occurs, what could be the typical impact? So they are either giving that kind of an estimate based on the data that they have collected from the external sources or even from their internal loss databases, or it could be the KRIs, the kind of benchmarks that have been set with respect to each of these situations. So for doing this, there are different approaches, but very common approach is a structured workshop. Otherwise, even surveys can be conducted or individualized discussions can be held to gather the data associated with the expert opinion on the losses in extreme situations. And especially, this is a very powerful tool when I am talking of risk for which I don't have the internal loss data or the external loss data heavily. The loss experience historically is not that much available, where the focus is on emerging risks. We don't have sufficient historical stuff associated with the emerging risks. So those kind of things are better dealt through scenario analysis. But the big challenge is whatever the opinions that we have collected, they have to be converted into numbers. We have to quantify that. So the more, though there are again different approaches for doing it, a very common way of doing it is when I am asking the experts, I'll ask them to give their estimate on loss frequency. So how many losses can occur for each different severity bracket? Okay, how many losses more than $1 million are going to occur? How many losses could occur between 50K and 100K? Now this is what we are trying to get an estimate from the various experts, in terms of the loss frequency for each of the severity buckets. But let's understand the fact that these are all estimates. These are given by the experts. So there is a possibility of some kind of prejudices, or there could be some level of biases that could go into the expert assessment. So that's where we are talking about the common issues. So general kind of biases which we look at: presentation bias. Probably I give event 1 before event 2 versus event 2 before event 1. It might very well have an impact on the expert's assessment. This is what we call as a presentation bias. So depending on the order in which the information is provided, the decision or the result that is provided by the expert could be skewed. So we have to be very careful in which order the question needs to be presented, the situation needs to be presented to the expert. So that is what we call as a presentation bias. And similarly, we have an availability bias. Probably the expert is not that much aware, he does not have the exposure to a particular risk event. So because of that, because he did not experience it or because he don't have too much of knowledge about it, he does an underestimation or an overestimation of a loss event. So we have to be very clearly able to understand this availability bias and make the necessary correction. Or we could see a scenario of anchoring bias. Generally, experts, based on their experience, they know that for a particular aspect the value lies between this and this. So they don't want to look at a value which is above this or below this. They are very much anchored to this particular thought. This value will be between this and this based on my experience. Now that is called as anchoring bias. Even that is possible in a scenario analysis. Or we talk about a huddle bias or anxiety bias. I really don't want to get into conflict with my other expert. So whatever my other expert has said or whatever the other group has said, I don't want to contradict that and get into a kind of controversy. I don't want to get into a difference of opinion with the other party. So whatever the other party has said, I simply second it or probably build on the top of it. Though that kind of a bias is also possible in case of scenario analysis, that is what we are calling as a huddle bias. Then there could be an issue with the gaming. So people don't want to really disclose any information. They don't want to participate too much in the workshop. They just want to observe what others are going to give as an information. They want to take the others' information and they don't want to actively participate in the workshop. So they don't reveal what their view is in a bigger way. That is what is called as a gaming. Even that could be a kind of a bias. Then the other important bias that could present in scenario analysis is overconfidence bias or the underconfidence bias. The experience not too much available. The person is not that experienced, and even regarding a particular risk, it's a new risk, emerging risk. So even the literature regarding that is not available to that extent. So in that case, I can either get into an overestimate or an underestimate. And the biggest problem in expert opinion, I did not get an expert to talk about it. So I just got a junior guy with less experience to give his opinion in the workshop. Probably that could result in too much of overestimate or underestimate. Even that kind of a bias is very much possible. And finally, even the scenario analysis is subjected to a contextual bias where the framing is done in such a way that The moment I change the framing, the opinion of the experts change drastically. So all these things we have to really keep in mind when we are collecting the data through the scenario analysis. Yes, no doubt. Scenario analysis is a very powerful tool in terms of collecting the loss data, especially where your historical data is very limitedly available. But while collecting, we have to ensure that these biases are handled appropriately. Now, just looking at different kinds of financial sectors, in which case, what kind of operation risk event is very severe, and in which case the frequency is much higher. So here I am looking at a few different financial sectors. So trading and sales, corporate finance, retail banking, and asset management. Look at the difference. In case of trading and operations risk, trading and sales, majority of the errors fall under the execution, trade execution, delivery, and process management. And the other things come under the client's products and business practices. Rest of the stuff are very minimally occurring. Probably the damage to the physical assets is a very rare event in terms of trading and sales. But look at the severity. The severity here is not that much as the frequency. Whereas the severity in case of clients, products, and business practices is much higher for the frequency occurred. And look at the other major area. Internal fraud, though the frequency is just 1%, occurs very rare. But when it occurs, it's a dangerous thing. The severity of the loss is 11%. In trading, sales, and ops risk, probably I consider internal fraud as a low frequency, high severity kind of an event. Right? Now, let's move on to the corporate finance area. In the corporate finance, again the client, products, and the business practices is the highest in terms of frequency, and probably it is the one in terms of severity. So in case of corporate finance, probably the major risk that I have to focus on is clients, products, and business practices. The only thing that I have to focus on. Execution, the frequency is much higher but with a very low severity. And all others are more or less minimal in terms of severity. So probably the only risk that requires a big attention in corporate finance is the client's products and business practices. But at the same time, when I come to the retail banking, the biggest set of risks occur with respect to external fraud. Right? The hackings, the physical assets damage. So you see the physical assets damage is just 1.4%, but external fraud in terms of theft, stealing of information, the dishonesty of the external parties, all those things, they even contribute 19.4% to the severity as well. But again, the clients, products, and the business practices, though the frequency is slightly lesser, their severity is much higher. The same thing goes with execution, delivery, and process management. Whereas when you look at employee practices, there are a lot of problems. Frequency wise, it's much higher. The employee practices, workplace safety kind of stuff, but their severity is not that heavy. And coming to the asset management, probably there's a lot of relationship with respect to trading and sales. Significant portion, both in terms of frequency as well as the severity, comes from the execution and delivery, and then the client's products and business practices. Similarly, the internal fraud, even there also it forms as a low frequency, high severity kind of a event. So some of the risks, they are very rare in all the different financial sectors, both in terms of frequency as well as severity. But the two or three broad areas which are affecting almost all the sectors is the risks that are associated with execution, delivery, and process management, the risks that are associated with client, product, and business practices, and in some cases, the internal as well as the external fraud. But on the other fronts, probably whether it is damage to the physical assets or business disruption and system failures, they are quite lesser in nature across all the various sectors, both in terms of the frequency of their occurrence as well as their severity. Now, with all this information, let's say now organizations have to go forward in terms of designing a risk management framework. So what are the different kinds of designs of the risk department? So one we look at, it's a central risk function which is purely a coordinator. They have no other role. They are only the facilitator here. The risk function, which is a centralized one, they are only the facilitators here. The business units are primarily responsible for implementing the risk management in their processes. So the central function, they only gather the information and report to the CEO and the board. So here the group size will be a very small group. So the business units, they just need to update the information to the central risk unit, and they are a part of the business units itself. Risk management is done as a part of the business units itself. That's a very primitive way because each business unit will have a different way of handling the risk, which will not create any kind of risk culture across the organization. There is no one who is typically owning the risk. There is no uniformity in the way the risk is handled across the organization. So this is a very primitive kind of a design. But going to the next, there is a matrix reporting where we are bringing in the dotted line relationship, where the business unit managers, risk managers are a part of the business unit itself, but rather than just reporting data just to the central risk function, they have a dotted line relation. They report to their business managers, business unit head, as well as they have a dotted line relationship with the central risk unit. So still they are appointed by the business units only. Compensation decisions are taken by the business units, but at the same time they have some dotted line responsibility with the central unit. So here now the effectiveness of this kind of a design relies heavily on what is the kind of relationship that is existing between the business units and the central risk unit. So it depends on the coordination and cooperation that is existing between these departments. So this is better than the design one, but again it has its own limitation. But design 3 is something which is more popular today, where we are talking of solid reporting to the central risk management. It's not a dotted line relationship. The risk managers are a part of the business unit, but they report to the central risk function. They don't report to the business unit manager, right? They report to the central risk function. They are still associated with the business unit. Now this makes the entire risk management function very, very centralized. So there the central risk function can very much prioritize the risk management effect across the various departments, across the various business initiatives, across the various business units. And this is what will promote a uniformity in the risk management practices across the organization. It promotes a homogeneous risk culture and consistent approach across the company. And the fourth one, probably, which is generally engaged by very large organizations, they have a very strong centralized risk management unit. They have a CRO, Chief Risk Officer, who is a key decision maker in the risk management. He is fully responsible for all the risks across the organization. He is responsible for monitoring, managing all kinds of risks across the firms, across the business units, and probably he has a control in terms of the entire risk function of the organization. And he reports to the senior management and the board regarding the status. So design 3 and design 4 are very solid kind of designs which can build a very homogeneous and a strong risk management culture in the organization with respect to the operations risk. So these are the various things that I wanted to cover as a part of this session. If you look at the summary, we have covered all these aspects in our slides today. If you have any further queries, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at the email address below. Thanks a lot for listening to this session. Thank you very much.